It's earnings season on Wall Street once again, and all eyes right now are turning to the Hollywood and entertainment sector, at least the eyes that we tend to track here on the Renegade Nation. Today, as a matter of fact, just after 4:30 p.m. Eastern Standard Time, we're going to be covering the live earnings call for Netflix, one of the major competitors in that space. But coming up are others like Warner Brothers, Paramount, and Comcast Universal. And the last one on the list will be November 17th, which we're already set up to cover for the Walt Disney Company. Make sure you join us for that one. In fact, like I said, the lobby is already open right there on our YouTube page. But what's interesting is recently this number of articles that have been coming out, this pretty growing list of articles, as a matter of fact, lamenting the issues that Disney is having in the parks, meaning that Wall Street analysts and Wall Street publications are starting to show signs outwardly of their concern for the Walt Disney Company and its at least short to midterm performance in the theme parks, the very bread and butter of the Walt Disney Company. That's a real problem. Disney can suffer losses on Disney Plus. Disney can suffer some losses at the box office, and it's not going to rattle people all that much unless you have a string of them for several years. Hint, hint, they have. But what really gets investors out there on Wall Street is what's going on inside the parks and resorts. And a lot of them are taking a very hands-off, cautious approach right now towards recommending Disney to their clients. And today, well, like I said, we've got a litany of articles to go through because, yikes, things don't look good at Disney at all. And I don't think Wall Street is expecting a whole lot of incredibly great news on November 17th during the next earnings call. Renegade Online. But I also look at what different Wall Street publications are saying. So we need to consider that as far as what do the people who actually have Disney stock, big institutional investors and a lot of it, what are they thinking? What are their analysts saying to their clients? What are their analysts saying about, their recommendations on the Walt Disney Company and where they think it's going? That's why I look at stuff like this, okay? Right here. This is from Piper Sandler, which is another investment firm. Now, this is from investing.com, published on Yahoo Finance. But we're talking about one of the analysts. This is a very recent update. This came out this morning, as a matter of fact, pre-market. Piper Sandler analysts started research coverage on Disney on Wednesday with a neutral rating, meaning we're not recommending that you buy it. We're not recommending that you sell it. We're just kind of sitting in the middle. And if you've got it now, sit on it. That's what neutral tends to mean. It's neutral and hold tend to go together, right? In investing parlance. The investment bank says it sees a limited upside to estimates in the following few quarters. Not weeks, not months, but the following few quarters. That's 6 to 9 months at least, okay? Due to a potential slowdown in the company's experiences segment, particularly in the parks business. And parks and experiences, like we said earlier in the stream, this is what drives Disney. Earlier we were talking about Netflix and how that earnings call tomorrow, my expectations is we're going to continue to see revenues rise for Netflix year over year. We're going to continue to see the profit margin of Netflix expand more and more and more. And Netflix right now is probably going to close its fiscal year having made almost the same amount of operating income as the Walt Disney Company on half the revenue or less. That's how good Netflix is right now compared to Disney, right? But the parks and experiences business for Disney is what drives everything. That's what drives the company. At Netflix, all they have is Netflix. It's just streaming. right? Disney is still basically losing money or breaking even on streaming. According to Piper Sandler, quote, "We believe the consumer-related slowdown within the parks business will likely persist for a few more quarters, and with experiences representing some 40% approximately of segment operating income, it's a profitability measurement, we do not expect a material upside." Oof. Oof. When you say that you don't expect a material upside, what that means is we don't expect things to get a lot better for Disney in the foreseeable future. It means that, sure, Disney could see some improvement in performance, and specifically regarding, say, the stock price, but we don't see anything significant on the horizon given the problems with the parks. And years ago, I sat here and I told you, when people would constantly ask me, how can Disney keep making flop after bomb after fail in the movie theaters and just keep plodding along? It's because the movie segment, the studio segment, doesn't mean diddly poo by comparison to the bottom line of the Walt Disney Company. Parks and experiences do. And in that same conversation, I told you that if Disney ever has problems with the parks, then it's going to hurt. We're here now. We're here. We are very much here now. Despite the short-term concerns, Piper Sandler expressed confidence in the Disney flywheel, and we have to dissect this next section too, because this is where I diverge from Piper Sandler's assessment, but there's good reason why I think they're wrong. They expressed confidence in Disney's flywheel and the company's ability to engage consumers through its diverse assets, including recent success in film. The firm acknowledged Disney's strategic focus on refining its film slate, investing in parks and experiences, and improving the streaming experiences, which could accelerate the company's growth momentum moving forward. Overall, we believe the flywheel is a differentiator within the entertainment industry, helping to provide both long-term growth and profitability drivers. The moderation in the experiences segment is seen as a temporary headwind following a period of robust growth. The problem is that robust growth in parks and experiences for Disney especially was due to us coming out of the pandemic lockdowns. We came out of COVID, pent-up frustration, especially with international travelers flooding in the parks. That has now abated. Now we're kind of back towards normal levels, and those normal levels are seemingly shrinking. Now, the problem and the issue that I take with Piper Sandler is the comment here, where they're trying to find a reason why things might get better for Disney. And it's a reason that, you've heard me talk about this even during the show, that I disagree with. The Disney flywheel and the company's ability to engage consumers through its diverse assets, including recent success in film. Deadpool and Wolverine, Inside Out 2. What did we just say about Deadpool and Wolverine? It is probably not going to translate into similar performance for Captain America 4. I don't think that Inside Out 2 is going to necessarily translate into similar performance for the next Pixar entry. Again, short of radical changes inside these studios. This is where I think some Wall Street analysts like Piper Sandler are missing the mark. And it's not necessarily their fault. Most of these Wall Street folks, they really don't understand what's going on inside these Hollywood studios. They really don't understand how much damage has been self-inflicted on these studios. People showed up like nutballs to go see Ryan Reynolds and Hugh Jackman because it was Ryan Reynolds and Hugh Jackman, and they were playing Deadpool and Wolverine. They didn't run back and spend $1.4 billion almost globally to see that movie because everybody was jumping up and down going, "The MCU is back, baby!" It isn't. It isn't. It's still very, very, very dead right now. Wall Street doesn't really get this yet. And Captain America 4 is just going to be driving another big railroad spike into that coffin. Okay? That's my assessment. Pixar and Walt Disney Animation certainly could improve. Moana 2, that's coming out in a couple of months, could be a big hit, and that may be a big help. But in terms of Disney getting that flywheel spinning as efficiently and as effectively as they had before 2019 and before 2020, I wouldn't bet any money on that yet. I'd be very, very cautious. Now, let me add some color to what I'm talking about here. Okay, talking about the parks, talking about the problems. All right. Disney's management, of course, and this was from the last earnings call where Bob Iger indicated this, where we might see a few quarters of not so great park results, right? Disney's management anticipates that the moderation will be short-lived, lasting only a few quarters, given current booking trends. However, Piper's team remains cautious and prefers to wait for stability in this business, the parks and resorts business, before adopting a more positive stance on Disney stock. So again, they're trying to be positive about the fact that they've had recent success in the box office. But Piper Sandler's analysts are, unlike others out there, when it comes to the parks, I think they're being smart. I think the caution is much more intelligent, my opinion. Because, like we discussed earlier, the headwinds coming their way of that's not going to be Captain America 4, not going to be a great movie in May. And at least I don't think it is as of right now. And then you've got the headwinds coming from an external threat known as Epic Universe at Universal Studios, which is now set to open Memorial Day weekend. They want to go head-to-head with Disney next summer, the entire summer. I don't think they know what's coming yet, and I'm about to show you some stories that I think maybe Piper Sandler was looking at when they very astutely crafted this letter to investors, this recommendation. They talk about DTC. They think, we'll see some profitability on DTC this quarter. I think we will, because I think Bob Iger found a way, come hell or high water, to make that happen, right? We talked about, hey, Skeleton Crew got pushed all the way till November before it is released, right? That was supposed to come out earlier this year. If they had actually released Skeleton Crew before The Acolyte, like they were supposed to, or like was said 2 years ago, that means they would have had to realize that potentially another $200 million expense on a show before the end of the fiscal year. Look how tight the numbers are right now on Disney Plus and DTC. 19 million, 47 million profit versus loss. I mean, it's right on a razor's edge. You throw in one extra show before October 1st. You throw in one more show, one more $200 or even $150 million show like Skeleton Crew before the end of the fiscal year that we just passed on September 30th, 2 weeks and 2 days ago. You have blown your promise to investors for 5 years. You have blown the ability to show profit on DTC. So you cancel stuff, and you reschedule stuff, and you delay stuff, and you push it back to a later date when then you can find a way to make up for it. How did they make up for it? By the way, we already know. They just jacked up the prices on Disney Plus yet again. And then they'll release Skeleton Crew. So they can bury that $200 million in the new price increase. Disney may be a bunch of jerks, but they're not stupid. They know exactly what they're doing. Make sure you're subscribed to Valiant Renegade and join us every Sunday at 6 p.m. Eastern for the live show.